Welcome to This Explainer. Okay, let's jump straight into a topic that, honestly, feels like the Wild West to most people. Yep, we're talking about cryptocurrency. If you've been watching the crypto space for even a minute, you know it looks like pure chaos from the outside. You've got people making absolute fortunes, others losing their entire life savings, and literally everything in between. But what if I told you that navigating this space isn't actually about luck? Today, we're going to completely flip how you look at crypto. We're taking it out of the realm of casino gambling and showing you how it can and should be run as a highly structured, calculated business.
So this brings us to the ultimate question, right? Is crypto just a giant scam, or is it a gold mine? What's really fascinating here is the psychology at play. When the market is down, like when everything is just crashing and burning, people panic. They think, well, crypto's dead, it's going to zero, and they run for the hills. But the very second a bull run hits and Bitcoin starts rocketing toward $100,000, suddenly everyone gets massive FOMO. They desperately want in, but the problem is they usually end up buying at the absolute peak.
And why exactly do they buy at the peak? Because they're following social media hype. We've all seen it. The memes, the rocket emojis, the influencers swearing some random coin is going to the moon. Look, following that hype is just painful. It literally only leads to buying high and selling low. So the absolute crucial point to understand right now is this. Real success in crypto doesn't come from memes. It requires a disciplined, strategic system. No guessing, no gambling, just pure strategy.
To get you there, here is our roadmap for today. Number 1, the crypto foundation. Number 2, investing versus trading. 3, the trader's toolkit. 4, strategy, trends and candlesticks. And finally, number 5, the golden rule of risk.
Okay, Section 1, the crypto foundation. Let's lay the groundwork. At its absolute core, cryptocurrency is just decentralized digital currency. Think of it kind of like transferring cash through a digital app on your phone, but with one massive, game-changing difference. There is no central bank pulling the strings. It operates on a public blockchain, which is incredibly secure. And, let's just dispel a massive myth right here. You constantly hear on the news that crypto is just for criminals moving black money around. But honestly, criminals have been using cash and gold for centuries. The true power of crypto isn't secrecy. It's that decentralized, highly transparent blockchain nature. Moving on to Section 2, investing versus trading, the two main paths.
So, you essentially have two paths to take here. Investing is when you buy an asset, let's say a fraction of a Bitcoin, and you literally just hold it for years. You're looking at fundamental analysis, figuring out what the project actually does in the real world, and it's a very low-maintenance approach. Trading, on the other hand, completely different beast. This is short-term. You're actively reading charts, doing technical analysis, and looking to capitalize on market moves over a few hours or maybe a few days. You aren't just throwing money at a coin and hoping for the best, you're actively executing a plan.
If you do decide to trade, you really need to pick a style based on how much free time you have. Swing trading means holding a position for a few days. Honestly, this is brilliant if you're a busy professional with a 9-to-5 job. Intraday trading means opening and closing trades within hours, but that requires you to be glued to your screen full time. Now, I do have to strongly warn you against a third type of trading called scalping. That's where you make tiny trades every few minutes. Look, in crypto, where price swings are absolutely wild, scalping almost always leads to emotional overtrading and totally blown accounts. So stick to swing or intraday.
Okay, now here is a concept that usually blows a lot of beginners' minds: short selling. How on earth can you make money when the crypto market is completely crashing? By shorting, you essentially sell an asset you don't even own yet, hoping the price drops so you can buy it back cheaper later and pocket the difference. I know, it sounds totally counterintuitive, right? Like, how do you sell something you don't actually own?
Well, this quote brilliantly illustrates how it works. Think of a real estate broker. When they rent or sell you a house, they don't actually own the house. They're simply facilitating the transaction between someone who wants to sell and someone who wants to buy. A crypto broker does the exact same thing, behind the scenes. They allow you to instantly short sell and profit from falling prices without ever owning the coin yourself.
All right, Section 3, the trader's toolkit. Let's look at the software.
Look, you can't treat this like a real business if you don't have the right tools. First and foremost, you need a top-tier registered broker. The sources for this explainer strongly recommend using FIU-registered platforms like Coinbase. These are serious institutions backed by major funds like BlackRock. Please do not use shady, unregulated apps to hold your capital.
Next up, use a site like CoinMarketCap to research the market caps and fundamentals of different coins. And finally, TradingView. This is going to be your best friend for pulling up charts and actually analyzing the real-time price movements.
Section 4, Strategy. Time to talk trends and candlesticks.
So the crucial thing here is understanding market structure. A market doesn't just shoot straight up in a straight line. It breathes. It moves in a rhythm. An uptrend actually has a very specific anatomy. Step 1, a low. Step 2, a high. Step 3, it pulls back to create a higher low. And step 4, it pushes up to a higher high. Once you can identify those 4 steps on a chart, the trend is officially confirmed. But as a strategic trader, you don't go chasing the market then. No, you patiently wait for the 5th step, the very next pullback, before you even think about entering your trade.
Now, when you are finally ready to buy at that 5th step, you zoom way in on the candlesticks on your chart. There are 2 very specific types you really need to know. First is the power candle. This one has a big, full, solid body. It shows immense buyer strength and is fantastic for confirming breakouts. The second one is the pin bar. This has a tiny little body and a very long wick, or a line, coming out of it. This shows that the market went down but was instantly and aggressively rejected by buyers.
Actually, to remember how a pin bar works, I want you to imagine accidentally touching a sharp needle. What happens? You instantly, violently yank your hand away, right? That is exactly what the market is doing with a pin bar. The price touches a certain level, experiences the sudden pain of heavy buyers stepping in, and instantly yanks back up, leaving that long wick behind. When you see that needle prick rejection during an uptrend, that is your golden signal to buy.
And finally, Section 5, the golden rule, risk, how to protect your capital.
I need you to listen to me very carefully here. You absolutely, without a doubt, must set stop-loss orders on every single trade. Period. A stop-loss is an automatic trigger that simply sells your coin if the price drops to a certain point. Do not rely on your own emotions to click sell when you're watching your money drain away in real time. You will freeze. We all do. A preset stop-loss caps your risk and protects your capital automatically. It is completely non-negotiable if you want to survive.
And that stop-loss feeds directly into the golden rule of trading, the risk-to-reward ratio, specifically 1-to-3. This simply means that for every $1 you are willing to risk on your stop-loss, your target profit needs to be at least $3. It's that simple. You only take trades where the potential reward heavily outweighs the risk.
And look at how this builds a literally unbeatable system through pure win rate math. Let's say you take 10 trades. Because trading is hard, you lose 60% of them. That's right, you lose 6 out of 10 trades costing you $1 each, so that's minus $6. But because of your strict 1-to-3 ratio, your 4 winning trades make you $3 each, that's plus $12. Now look at the net total. Even though you were flat out wrong 60% of the time, you still walked away with a $6 profit. Seriously, this is the absolute magic of disciplined risk management.
But of course, there is a trap in this space, and it's called leverage. Leverage is when you borrow capital from your broker to multiply your buying power. You can literally turn a $1,000 account into a $50,000 trading position using 50x leverage. And yeah, when you win, you make massive profits. But this is the ultimate double-edged sword. If you use 50x leverage and the market drops by just 2%, your entire account is liquidated, just gone. If you are a beginner, please keep your leverage extremely low, around 10x, until you know exactly what you are doing.
Because surviving in crypto is ultimately about psychological discipline. You must limit yourself to a maximum of 1-to-3 trades per day. Don't just sit at your computer for 8 hours mindlessly clicking buy and sell. And if you hit your stop-loss limit for the day, shut the laptop, walk away. Emotional overtrading, trying to quickly win back the money you literally just lost, is the absolute fastest way to destroy your entire portfolio.
Which brings us to the core philosophy of everything we've talked about in this explainer today. Effective trading is about protecting your capital, not just multiplying it. Look, amateurs obsess over how much money they can make, professionals obsess over how much money they can lose, and they fiercely protect their downside.
So we've covered the structure, the tools, the strategy, and the math of effective crypto trading. It's not a magical mystery, and it definitely doesn't require luck. It just requires a system. So I want to leave you with this final thought. When you open up your charts tomorrow, will you treat your very next trade like a blind casino bet, or will you execute it like a calculated business decision? The choice is entirely yours.